Hello, my name is Nikolai and I'm CEO and founder of as.exchange, the innovative derivatives exchange platform. And this is the first video from the series about what is Tranched Value Security, which you can trade on as.exchange, and what are the benefits of this financial product to manage your risks and improve your returns. So let's get started by defining what is Tranched Value Security. Tranched Value Security, or TVS for short, for which we already applied for patent, is a security whose income or value is derived by the value of another asset, or it means backed or collateralized by another asset, such as Bitcoin, some stocks, bonds, or any other possible asset. It can be also a group of assets, stream of cash flows, or any other thing which has a value. Therefore, TVS is a derivative because it derives its value from another asset. So if another asset doesn't have a value, TVS also will not have. But as long as the underlying asset has any value or price, TVS also will have. And here are the most important parts about TVS. First of all, TVS derives its value either from value share of specific underlying asset or from minimum contract value, which can be equal to the value share or can be something different. So variable value share is usually defined in percentage terms. So for example, if Bitcoin costs $100 and TVS has a variable value share of 50%, so the value of TVS is $50. The fixed value share is determined at the beginning of issuance of TVS. So if today you issue TVS with a fixed value share of $60, then it will always stay $60 and you cannot change it afterwards. The second important feature about TVS is that TVS can never be equal to 100% of underlying asset, because if that is the case, then it's just same with underlying asset. Therefore, for any underlying asset which has been securitized, there will be at least two TVSs. And the most important feature of TVS is that their value is determined depending on the seniority of each specific value tranche, which means that if there are two TVSs, for example TVS Senior or TVS Junior, the Senior must be paid off or has a value before the Junior one can get any payoff or can be assigned any specific value. So that means if you issue two TVSs with a fixed value share and variable value share of 50% and $50, while Bitcoin costs, for example, $100, and afterwards Bitcoin dropped to the price of, let's say, $60, the first TVS, since it's more senior, it can claim the value of $50. For the second one, which has fixed value share of $50 as well, it cannot claim anything more than what is left basically. Otherwise there will be arbitrage opportunities which will be cleared in the market by arbitrageurs and other traders. Therefore, as I mentioned earlier, before any subsequent TVS or tranched value security can be satisfied in its payout or in its value, the previous one or the more senior TVS must be satisfied. If the more senior one cannot be paid off, the junior one cannot be paid off either. So here's the valuation model, like how to determine how much a TVS can earn. So this TVS IT is the value, the price of any TVS at any specific point of time, and it equals to the underlying asset ST minus the most senior TVS value, which it claimed. So if it's the most senior TVS, this will be 0. If there are other TVS, this will be not 0. Or the maximum variable value share times the underlying asset price, or the fixed value share. So it means the holder of TVS will choose naturally whatever is more. So if Bitcoin is today $80, while the fixed value share is $50 and variable value share also $50, this part will equal to 40 and this part will equal to 50, the fixed value share. Therefore, naturally, the holder of the TVS will choose 50. To make it more clear, let's look at the example of similar securities, which are called mortgage-backed securities. And as you probably know, in order to issue different types of mortgage-backed securities, you need a pool of assets, mortgages, which bankers typically put together and split the value into different tranches depending on the risk and of course depending on the return. So while these mortgages, they make payouts to this common pool, this pool distributes the value or the payouts or cash flows to these tranches. The first one gets the payouts first, of course, and these payouts in percentage terms are the lowest ones, since they're the least risky ones, while the subprime or mass tranches, they can get the highest return, but they're the most risky ones. So that means if, for example, for whatever reason, several of these mortgages stop paying, so this pool will decline, and this tranche potentially will not get anything, while this one will be getting first. So the only difference between mortgage-backed securities and TVS is that TVS does not need a pool of assets or pool of cash flows in order to split the payouts of value, because we securitize not the assets, not the cash flows, but the value of asset as presented here. So for example, this can be 1 Bitcoin, 1.5 Bitcoins, or 113 stocks of Apple, or whatsoever. This combined has specific value, which is equal to value pool. And this value pool is split into different tranches. And the most senior one, of course, has the lowest risk, paid first, but it has the lowest return, of course. While the most junior one has the highest risk, paid the last one. So it will not get anything before this will get something. But of course, it has the highest return as a compensation for the highest risk. So let's get to the calculation and how it actually works in the market conditions. Here you can see the basic calculation and example of TVS backed by Bitcoin, and later on I'll show you the calculator which we have on our website for your convenience. But for now on, let's imagine the initial price of Bitcoin is $100. So it's of course 100% backed by its own value, and whatever happens with Bitcoin is illustrated here. So just for example, imagine that Bitcoin goes up by 5%, declines by 5%, goes up by 10%, declines by 10%, and so on. So let's imagine the first example where we issue only 2 TVSs based on this Bitcoin. This TVS has, for simplicity, variable value share of 50% and fixed value share of $50 as well. The second TVS has the same parameters, but it's more junior one to this one. So TVS 2 represents more junior one compared to TVS 1. So when Bitcoin goes up by 5% only, both TVSs perform same, because if you imagine that asset continually goes up forever and never goes down at all, they're gonna perform totally same, just as if you would split the value and nothing else. But since we have the seniority feature here, when the Bitcoin starts to decline by 5%, for example, the most senior TVS declines by 4.8%. The more junior one declines by 5.2%. And here the difference is not that significant yet, but when the return is more volatile, such as here, you will see bigger difference. So for example, when Bitcoin declines by 20%, TVS senior declines by 13%. By the way, it's 13% as if somebody bought this TVS at this point. But if you're just the holder from the beginning, then it's still saying $50, so your return is basically zero. You didn't lose anything, you didn't earn anything, it's just zero. But if you bought here at this point, then the return is minus 13%. But for the junior one, the return is minus 26%. And that's because of the pricing model which I showed before. So for example, at this point, the Bitcoin costs $92. So this TVS can choose either 50% of 92 or $50. Being a rational trader or investor, you would choose, of course, the more, so $50. And because of this TVS can choose also $50 or 50% of this, given that this is satisfied. But because 50% of this and $50 will be more, that's why all what it can get is the leftover. So 92.7 minus $50 is 43 or 42.7. Therefore, the return for junior TVS is more negative. But afterwards, after this, if Bitcoin goes up by 30%, the most senior one goes up by 20%. Like 60 divided by 50 minus 1, it's plus 20%. But this one goes up by 40%. So imagine at this point, like when Bitcoin declined by 20%, you think, okay, that's enough for you. You want to sell the junior TVS to someone, and that somebody just bought it from you for, let's say, $43. So for this person who bought it here, for example, the return here will be 41%, which is more high than senior TVS and more high than even Bitcoin. And it gets more significant once the price volatility increases, as here, for example, Bitcoin increased by 50% after a decline of 40%. This TVS earns only 6%, but the junior one earns 155% without leverage. So here, for example, on this chart, you can see the price changes. So as I mentioned earlier, the combined price of all TVSs cannot be more than the price of underlying asset, which is Bitcoin in this case. Otherwise, there will be arbitrage opportunities. Therefore, this down part represents the more senior one. The upper part represents the junior one. Therefore, once the price of underlying asset or Bitcoin declines, the first one, the junior one, gets hit most. The senior one gets hit afterwards if Bitcoin declines even further. So here's example with 3 TVSs just for your reference, and imagine the same Bitcoin, same price returns, but you issued 3 TVSs, the senior one having variable value share of 50% and the two others 25%. So what this means is that this TVS gets the value of payout first. This TVS, let's call it middle one, will get payout second, and this TVS will get the payout after these two satisfied, so the last one. Therefore, in this condition where, for example, Bitcoin declines by 40% after all of this, the third TVS becomes zero because there's not enough underlying value to satisfy this payout. This TVS becomes 21, having a return of minus 29, and this TVS has a return of minus 15, again, as if somebody bought at this point. For the holder from this point, basically this TVS didn't change in value, as you can see 50-50. This TVS, okay, declined a little bit, 25 to 21. But this one 25 to 0. But afterwards, at this point when Bitcoin increases by 50%, the senior one earns only 6% from this point, as if somebody bought at 50. This TVS earns 27% from this point, and this TVS earns something. So here's the thing, because this TVS became 0 in value, the model calculates the value as 0, but in reality, it's not true, because as you see here, this TVS can get again the value in any point of time. Therefore, this can never be actually 0. Because assuming that Bitcoin is volatile or any other asset, unless it's totally inexistent from now onwards, this will never be 0 because there's some part of future expected value. How much? It's up to you, because you trade, you have your own risks, you have your own expectations. Therefore, it's up to you to decide how much you believe this is worth of. Therefore, just for example, let's imagine it's $1. So you sell it or buy it for whatever for $1. And afterwards, when Bitcoin increases in value again, this earns from $1 to 27, basically 2,500% return, which is fairly possible because Bitcoin increased by 50%. We saw it in real life many times. This one consequently earned 2,500% return. And yes, important point is that the variable value share and fixed value share. So the fixed value share does not have to be equal variable value share times the initial price. So it doesn't have to be 50% times 100. So you can make it 50% and this one $60, 50% and only $10 or maybe even more. It's totally up to you. And you can issue as many TVSs as you wish. Just this table shows 2 examples. But normally on our platform on as.exchange, we don't recommend you to issue more than 10, because in that case, each of those value tranches becomes highly sensitive to price changes. Therefore, each of them will have high risk. And for now on, please don't care about these 2, I'll explain them later. So for your convenience, we created a calculator on our website where you can automatically check all those things and you don't need to actually input anything in this sheet. So here we go. This is the calculator which you can find under the resources tab on as.exchange, and here you can automatically and fairly quickly calculate how much you could earn with the given parameters of TVS. Currently it supports only Bitcoin and Ethereum, but later on we'll add other assets as well. So first of all, you need to specify what is the date you assume you issued TVS. So let's say it's 2019 September 12th. And here you need to choose how many TVSs you want to issue. So as I mentioned, currently we support only 10 value tranches, simply because we don't recommend to issue more than that, otherwise each of them will become highly sensitive, but later on you can issue as many as you wish. So let's say it's 4. By default, this variable value share and fixed value share are as I explained. So this one is just x divided by n, which is 4 in this case, and fixed value share is just variable value share times the underlying price at this specific date. So on 2019, 12th of September. You can change any of these parameters if you wish, but for simplicity, let's assume it is just like that. So here we go. Here you can see the different metrics about the Bitcoin for this period from the date of issuance of TVS until today, which is December 10th of 2020. And of course the parameters of TVS. So for example, the last implied price of Bitcoin, which is today, is $18,000. TVS's all cost the same price, and that is because today price on December 10th, 2020 is higher than what was observed on the date of issuance, which is 12th of September 2019. So here you can see the variable value share, which is for Bitcoin, of course, 100%. For TVS is as we said here. The fixed value share, which is again this. And different return parameters. So for one day, they earned all the same, which is from December 9th to 10th in 2020. 7-day return, which is also same because it was increasing mainly. For 7 days, it's also mostly same. For 3 months, it's also same since they increased. They all increased since the 3 months. And here are the interesting things. So the mean return, 1-day return for Bitcoin was 0.21%. For senior TVS, TVS1 specified here, is 0.15%, which is less because less risk than Bitcoin. TVS2 also 0.15%. TVS3 1.78, and the most junior TVS4, the mean return is 3.16 per day. And by the way, I should mention that this model assumes that the value of TVS is possible to be 0, which is not realistic, as I mentioned earlier. Therefore, actually these values will be different. So this one will be way higher. And same applies for median, mode, minimum, maximum, range, and etc, etc, etc. So at the minimum 1-day return of Bitcoin, it was almost minus 40%. For the most senior TVS, the minimum 1-day return was minus 10%. Second most senior, also minus 10%. While for the other two, minus 100, minus 100. At the same time, you can see the maximum return, 1-day return for Bitcoin was almost 20%. For senior TVS, plus 10, second senior also plus 10. For junior TVS, 700% in 1 day. And for the most junior one, 500, which again is not realistic. Actually, it will be higher if you assume that 0 values are not possible in real life, because assigning a 0 value means that somebody gives you TVS for free, which I assume nobody will do. And here you can see the return correlations. So that's correlation of Bitcoin return with TVS1, Bitcoin with TVS2, Bitcoin with TVS3, and the most junior TVS. So as you can see, the correlation of returns of Bitcoin with the most senior TVS is only half, which shows that holding the same basically Bitcoin as underlying asset but having it securitized and issuing TVS, you had correlation of half. And you can see the most correlated one was the second most senior TVS with 0.60, and of course the least correlated one was the most junior TVS with 0.38. And here you can see on this graph, as was shown in the Excel spreadsheet before, the down part is the most senior TVS, which means it will get hit by the price drop of underlying asset the last, while the upper part is the most junior one. So if Bitcoin goes down in price, it will be hit first. Therefore, at some periods of time, it was 0 value, as you can see from TVS4, 0. And here you can see the securities performance, which means a return, and the chart is limited to plus 100 to minus 100, otherwise it will be very ugly actually. Because as you saw from here, some of the return patterns can be very extreme for junior TVSs. Therefore, it's only this much, and you can see how different they are all from each other. So feel free to play around with these different parameters. You can select another date such as 2018, for example, July 13th. And you can issue, I don't know, 6 TVSs. You can change these values. The last one will change accordingly because, as I mentioned earlier, the total cannot be more than 100. And here you will see the corresponding changes as if you would securitize your 1 Bitcoin on this date, 13th of July 2018, and would issue 6 TVSs and assume you sell some or don't sell, up to you. But this value was basically same as shown above. These ones have changed significantly: minimum and maximum return, medium, mode, variance, standard deviation, kurtosis, and skewness. So as you can see, the maximum return was for the most junior TVS, TVS 6, was 7,694% in 1 day. So just imagine you earned this much only in 1 day. If you would buy this TVS from the person who securitized Bitcoin and issue it on this date, 1 day before, you would earn this much. Again, without leverage, without risk of being liquidated, and without any other typical risks of derivatives. And here you can see the return correlations. Of course, Bitcoin with Bitcoin 1, Bitcoin with the most senior TVS 0.85. But here's the interesting thing. The most junior TVS with Bitcoin return correlation is only 0.18, and the most junior TVS with Bitcoin is only 0.09. And here it's even more interesting. The most junior TVS with the second most junior TVS return correlation of 0, and same here. So you can imagine how much you can diversify your risks, your market risk, your returns by holding TVS backed by the same, totally same asset such as Bitcoin. For now, as.exchange works only with Bitcoin, but we'll soon will be adding other assets. And here's the last point, which I said I will mention later, about attachment and detachment point. So attachment point means by how much the underlying asset, which is Bitcoin in this case, needs to decline in price in order for this specific TVS to start losing in value. So for example, for this most junior TVS, the decline in Bitcoin price by even 0.000 whatsoever 1 will start to reduce the value of this TVS. But for the most senior TVS, in order to start decline in value, Bitcoin needs to decrease in value by 83%. So if Bitcoin decreases in value by 80%, this TVS still doesn't lose anything. But once the Bitcoin declines by 83.33%, this one starts to lose money. And the detachment point is by how much the underlying asset such as Bitcoin needs to decline in value in order for this TVS to become 0 according to this model. So for the most senior one, Bitcoin needs to decrease in value by 100%. So it means Bitcoin needs to cost $0 in order for this TVS to cost $0. Otherwise, it will be anything but 0. But for the most junior one, it's 16.67, which as you can see is basically a variable value tranche. So being more specific, for most senior TVS in this case, in order to start losing in value, Bitcoin needs to decrease by 83%. And in order for this TVS to become 0, Bitcoin needs to become 0. But for this TVS, the most junior one, Bitcoin needs to decline by anything, even a little bit more than 0, it will start to lose money. And Bitcoin needs to decline by 16.67%, and then this will become 0 as well. So thank you again for your time, and hope to see you soon in the next series, and wish you good profits with as.exchange.